All right, well, the TSX pulling back again today. The source of the weakness, those marijuana stocks that have really been the source of strength when we were on that hot streak, really punching above their weight, their literal weight on the TSX. It's very small, but because of these huge gains, sometimes up 100% over just a few trading sessions, you saw it actually start to move the index into that record territory yet again. John Zechner is here to break it all down for us. John, it's pretty incredible considering the makeup of the TSX to see, sectors like materials, energy down, but to be hitting new highs because of Shopify and marijuana stocks.
Yeah, you've seen a lot of sort of bifurcated days like that lately, Amber, where, as you say, the highly, they're not big pieces of the index as much, but certainly, the Shopifys of the world and the healthcare stocks of the cannabis, oxymoron there, are sort of carrying the weight while some of the cyclicals pull back. And then when it goes the other way, obviously, you can still drive the indices higher. But generally, we have done like a lot of people you probably talked to lately more that sort of a value shift in our portfolios recently. We're remaining, pretty much fully invested. But, I think there are areas of speculation in the market and areas of risk that remind me a lot of 1999. When people say this is not like 1999, I think, well, either you weren't around then or you have a shorter memory, because I think you've got some massive speculation in some areas that cause risk. But, you can have that break apart and still have areas that are safer. And we've added to energy and financials, and to a degree, you really have to believe in the recovery trade. And I think a classic example is just before you were. We started talking here when you're showing Air Canada the open. I mean, Air Canada missed the numbers. It's sort of, we know what they're going through and how much cash they're bleeding every day, and the lack of flying. But if you believe that at some point later this year into next year, into a more normalized economy, the vaccines start to work, we get back to some normal levels of spending. These are the stocks that are down still 60% from the peak, that have done well, that are the survivors. And we've added this. I'm at the top pick recently, and I think the fact that it's up despite dismal results this morning. It's an old adage of the market: when stocks don't go down on bad news anymore, it's probably time to start looking at them.
Yeah, and it's one of the best performers right now. The second best performer on the TSX, continuing to gain momentum, now up about 6%. One of the other sectors you talked about is energy. And despite the fact that we've seen oil prices move up, those Canadian oil producers, not just the pipelines, but if you strip those names out, those energy producers have underperformed the commodity, have underperformed peers south of the border. What's going on there, and why do you find it attractive despite that?
Well, you're absolutely right, Amber. But there's with the shift towards more ESG investing, you've seen money sort of move away from fossil fuels and into renewables in a huge amount, and that's depressed the valuations. It's not unlike what you saw, I think, in the tobacco stocks in the 1980s and 90s degree. As money went out, in the end, these stocks ended up remaining good investments because they weren't, there wasn't as much growth there, but they were spinning out a lot of cash, and they ended up, investing the cash elsewhere and paying it back as dividends and buying back their own stocks. They were undervalued. I mean, a lot of these energy companies at, $50, $55 oil could sort of buy back the entire market capitalization of the companies over a couple of years. So, they may not be the area that draws a lot of new attention, that draws a younger investors, and they don't meet the ESG criteria of a lot of funds. But in the end, I think the valuation is there, and they're spinning out a lot of cash. And if energy prices hold around these current levels, we're seeing lots of decent buys. So it's not a massive overweight in the portfolio, but I'm seeing opportunities, and I think there'll be more consolidation in the sector. We saw that yesterday, sort of with the ARC 7 Generations deal as well, that it'll create more value there, spin out more cash to shareholders. And like I say, to me, that's a little reminiscent of the, like I say, the tobacco stocks once they went out of favor back in the 1980s.
How patient do you have to be for those returns to come to you? I guess in an era where we're used to stocks doubling now in a week.
Yeah, well, that's a good point, Amber. I mean, I think patience is always a virtue in investing, and I've been doing this almost 40 years. And sometimes you wait a long time, and some of the biggest mistakes I've made is sort of having a good idea and then getting too impatient because it didn't come about, selling it, and then watching the thing go higher for the exact reason I owned it all along. So I think you got to stick to the fundamentals, the valuation. You have to have a bit of a belief going forward that this economy is going to start to get better. But again, I think you you've got a lot of good material in the background there. I mean, the fiscal backdrop we've got right now with the spending in the U.S., the spending globally you've seen out there, and going forward as well. The pent-up demand, I think, from a higher savings rate we've seen, the monetary stimulus for all the central banks that's going to remain in place for a number of years. You got a lot of tailwinds at your back. I think we reset this economic cycle to the beginning, so we're going to have some ups and downs and some falls because of the areas of overvaluation. But I think the path forward over the next couple of years looks pretty good. And just to think that all this stimulus won't lead to some better economic growth once we sort of get through this pandemic is almost like saying I gotta go outside in the rain and not get wet. I think it's going to happen, Amber. It's just more a matter of timing, and as it does, like the recovery in 2000, I think you'll see these stocks that have lagged, that are more economically sensitive, are going to start to do better.
All right, so it sounds like you're stitching together a theme here where it is, position to value, position to reopening, even though there's going to be some bumps on the road. With that in mind, I don't know if you saw, we talked about it earlier this morning, Bombardier was upgraded to buy by RBC, Walter Spracklin, who's also been doing this a long time, and said that it was ripe for a deep value investor. Is this a name? I mean, it's broken a lot of hearts for a lot of years. So calling it a buy can be a risky proposition. But, based on how you're seeing things, is this a name that, you might take a look at?
Well, I took a look at it, Amber, and it's a good point, and it's sort of almost a thing that would get the Reddit crowd and all going because it's low price and it's come down a long way. But when I looked at it, still, the balance sheet is a mess. We're still looking at sort of 10 times debt to operating cash flow. I don't see the business is growing as much. So yeah, I will look at stuff like that. But balance sheets can still get you in trouble, and you got to be generating cash. So I think there's a lot to pick from. Bombardier at these levels, I don't think it's really on a risk reward basis worth it. I'm finding lots of other areas where I don't have to take as much risk and can still get some upside. Like I say, some of those energy players, the financials, we're still keeping a technology bet in place. And I mentioned in Air Canada, but I think they've got a superb balance sheet because of all the cash they raised in a downturn, and they're sort of positioned well going forward. General Motors sort of has a decent play in the recovering auto sector despite the current chip shortage. If Tesla's could be worth $800 billion, GM with its EV division is going to be worth more than $70 billion. So,
are you touching any of the hot stocks recently on the TSX of the pot stocks, Shopify?
We're not long any of those right now, but I run a long-short hedge fund, Amber, and the idea in a hedge fund always is you go long your best ideas and short where you think it's overvalued. But this whole thing with Wall Street bets and the Reddit crowd is shying me away from that. I mean, normally yesterday I would have been shorting Canopy when it had gone up to 70. I looked at it, but it's crazy. I mean, we're talking about 25 times revenue for a company that's basically produces a commodity that's falling in price, no operating cash flow, but you can't. You will get stung so badly if these things go in the other direction. We benefited from that by being long BlackBerry. But in my hedge fund, what I've gone is a different strategy now. Is we get long the stocks we like, but the only shorts I take will be indices to protect. You always have shorts to protect your long side. So I will short, basic indices. But right now I'm avoiding getting short any of those individual stocks. Would I buy those in here, Amber? No, I'm an old style. I mean, the Senate, people in politics call the Senate of sober second thought. I think of myself as a senator on the investment side, maybe the chamber of sober second thought. And I look at valuations like that and I saw this in 99, 2000, and it didn't work then. I don't think it'll work now.